Hey everyone, Meet Kevin here. Welcome back to another episode of the Meet Kevin Show. Y'all know I love getting perspective on anything related to inflation, the market crash. Are we going to crash again? How bad can things get? What should we invest in? What should we not invest in? I love all perspectives. And folks, today we have the chief market analyst over at ITM Trading, Lynette, nicknamed the Data Gal. Was so grateful to come on, and I cannot wait to have a conversation. Lynette, welcome aboard. Introduce yourself.
Well, I'm Lynette Zang, and I'm very happy to be here today. And I would say that I've been in these markets on some level since about 1964, so we can go wherever you want to go.
That's amazing. Well, let's get started right away, if you don't mind, with what is happening in this bond market. Is this something we have to be massively concerned with? How do we play this? What's your take on this?
Well, first of all, people have to understand that bonds are debt, and in this system, that's how money is made. And so created, I should say. And so, yes, I do think people need to be very concerned about debt, because if you look at it, whether you're going from, the top down, so a government, a corporation, or an individual, at the end of the day, the laws of economics work the same for everybody. It's just that at this juncture, and particularly with governments and their ability to create debt, and what we see globally, central bankers going in and buying that debt, that really is a big indication that we have some problems in that market. And I'd also say I'm sorry.
But I was just going to say, so what you're saying is this injection of like $120 billion coming from the Fed to buy up our T-bills and mortgage-backed securities, that's an issue. Monthly.
Let's just say that monthly. Well, it is, because up until December, I'm pretty sure it was the 18th of 2002, the Federal Reserve didn't buy any of our debt. They didn't need to. But as the, I guess you would say, financial power of the world started to shift. I mean, we still hold the world reserve currency status, right, but that's been shifting now. These things don't really happen overnight. So that's really been shifting since, well, around 2000 is really when they brought in the euro to take over, etc. So yes, I do think that the government going in and the Federal Reserve going in and supporting government spending, that's monetizing the government debt. And yeah, I think that's a problem.
That's interesting. So, I mean, really back in the early 2000s, the 90s, I mean, the yield curve, yields on like the 10-year were much closer to 6-7%. Mm-hmm. They were much higher. And so maybe it was more appetizing for companies and corporations to say, hey, well, let's just buy bonds. But now it's like, why would you buy bonds at, 1.9% on the 10-year, or sorry, 1.6, I think is where we are now, 1.67. Can this sustain itself, or is this going to create issues?
Well, no, it cannot sustain itself. A system that's based purely on debt can never sustain itself, because at some point you have to deal with the debt. You either pay it, you roll it over, or you default on it. So you have to understand that by design, and when we went into a full debt-based system, and I was there in the early 70s when we transitioned from a gold standard to a debt standard. So I was, right, I was in my teens, so I didn't really fully understand what was happening. But I definitely remember the energy in the air. I definitely remember all the chaos around everything that was happening, civil rights, women's lib, oil embargo. I mean, there were a lot really high interest rates and inflation, et cetera. I definitely remember that. And it feels very similar to me now. It feels very, very similar to me now.
And that's a little scary, because I mean, that's not something you have forgotten by any means, and that's something that is so salient in many people's belief that, hey, what if we get hyperinflation again? I mean, this could be a big problem.
Well, let's kind of talk about that, because when we are in the midst, we are already walking through a currency regime shift. It's much bigger than that, just like it was in the 70s. It's also a social shift and an economic shift.
Because of
So,
Bitcoin, or
pardon, what about
is that
Bitcoin?
because of Bitcoin, or
Oh,
what do you
no.
mean with the currency shift? No. Okay.
No, the currency shift is when they've used up all their old tools to keep things going, which
Yeah.
they have right now, because the biggest tool is interest rates. Interest rates have been anchored at zero, so going back to that whole pile of debt. But if you're talking about Bitcoin or cryptocurrencies or central bank digital currencies, technology has sped up a lot. I'll tell you something.
Yeah.
I was just thinking about this the other day. My grandfather lived to be 99, and he was born in 1864. And I used to think, wow, look at what he saw in his lifetime. I mean, he saw
Yeah.
automobiles, he saw electricity, he saw telephones, he saw major changes happening over the course of his lifetime. But as technology has advanced so much, the pace of those changes has sped up. And so I was born in 1954. The level of change that I've seen in my lifetime has far, frankly, surpassed what my grandfather used to say, during his. And it'll keep getting faster. And the information keeps getting faster. So I read the NSA white paper in 96 on how to make a fortune from cryptocurrencies. And I think, my opinion on it is Bitcoin and the other cryptocurrencies that came in were really about getting us used to making that transition. And they're going to have to burn off this debt first. I did a whole bunch of digging to see, particularly around central bank digital currencies, to see what would justify the creation. Because for a while there, it seemed like they were going to a transaction-based new currency method.
Yeah.
First of all, it was really hard to find any reference to it. But the little that I did, they're still talking about basing it upon debt. So they've got to burn the debt off. Right?
So, in other words, to piece this together, it sounds like you think that this digital coin revolution and digital currency revolution is here, or it's coming. But in order for there to even be any kind of transition to that, whether it's a Fed coin or it's Bitcoin or whatever, which we could talk about that, in order to actually have any kind of transition, we have to realize the fact that we're now, almost $30 trillion in debt, and somebody's got to pay for this, is what you're saying.
Oh, yeah. I mean, there's really no choice about it. You need a clean balance sheet if you're going to start a whole new regime, because how in the world can you start a new regime when you cannot afford the old regime? Right?
Yeah. How do you think they're going to do that? I mean, couldn't they just kick the can down the road and just keep rolling that money printer?
Well, that's what they've been doing, but the real key in here is confidence.
Okay.
Right? As long as the public has confidence in the central banks and in the government, then they can keep kicking that coin. It doesn't mean there are no consequences to it, but yes, they can keep kicking that coin. The problem is that people have been losing confidence. And there's, lots and lots of studies on that, and confidence has been declining. And I think that's a big reason why this time they have to give the money to the public, because they're trying to calm the masses. And we saw before the coronavirus kicked in, all of the global riots and upheavals and, and move of populism, et cetera, which is pretty typical. That's actually really typical during a currency regime shift. But that gave them, the coronavirus gave them the ability to quash that. Look at Hong Kong. I mean, that's like the absolute perfect example.
Wow.
Right? And
I mean, so that's actually very interesting, because, well, first of all, you're one of the few who is linked confidence to inflation and the stability of currency. And I think it's so important because if you look at countries that have hyperinflated, like the Weimar Republic or Zimbabwe or a South American country, whatever, it's always linked to a failure of essentially the government institutions, that people don't trust their currency anymore, so they do whatever they can to get out of it. And so I first of all, thank you for bringing that up because I completely agree with that linkage. And now what's interesting is you're going from that, which I'm curious how you measure confidence, we'll talk about that, to saying that, as people lose confidence, why not just inject them with stimulus is what you're saying, and settle them down.
That's exactly what they're doing. You throw meat to the masses, and then the masses go, okay, I can feed my family. Maybe it's not so bad. And that's really why we've got to have UBI, Universal Basic Income, even though that will really be, I think, in my opinion, the catalyst, the ultimate catalyst for the hyperinflation to kick into gear in earnest, right? Because now there'll be lots of this free money. I mean, anytime anybody says something is free, you really have to look at what the real cost is. But instead, people just go, well, yeah, I don't want to pay any fees. So if this is free, that's great. And look at all this money. I mean, why do you think we've got this? This is really hard for me to say, but great economy right now, right? Because of all of the stimulus money that's been going to, well, not just the banks and the corporations. I mean, that's free money. You might as well lever it up. Lots of leverage. But the individuals in this current package that they just put out, I believe a family of four, I could be off on this a little bit, but a family of four earning $150,000 a year is likely to benefit by an additional $14,000 via the current stimulus package.
Sure.
Now, I know $150,000 a year kind of sounds like a lot of money.
Yeah.
But why does somebody at that level need to be stimulated? Because it's not really that much money. People earning $100,000 a year are still paycheck to paycheck.
Yeah.
Right? And heavily in debt, which you have to service the debt or default on it. So
or go bankrupt, exactly. Yeah, which then you're screwed for 7 years. Yeah.
Maybe so, maybe not. I mean, I've heard of people that have gone bankrupt and shortly thereafter, because they couldn't do it again for another 7 years, got lots of credit card offers.
Of course. Well, the way things are changing. So, okay, I want to unpackage this because you mentioned that you think the populism that we're seeing now is something that basically is a symptom of people's lack of trust in the currency. So the more populism you get and the more of this printing you get, the more people kind of potentially lose trust, but the more they need to print more to go, no, don't worry, it's still good. Here's just some more money.
Right. Didn't we see that in March, right? And you had all those central bank presidents, going out and saying, well, hey, look, there's people are wanting cash, so we'll just print more. That's no big deal. We'll just print more. We can print an unlimited amount. And when you look at the M1, the base money supply, it's straight up. It's straight up. And it's still straight up. So they prevented the run on the bank by making sure that there was plenty of cash in there, but there are other things that are also happening. And it's not so much that people are losing confidence in the currency because they don't understand inflation. It's that they're losing confidence in what they view as traditional institutions. So central banks, governments, and Pew does research on that all the time. There are lots of confidence studies that happen. So you can actually see the decline in it. And
yeah, because a traditional person, or just somebody who works and doesn't have time to talk about inflation all day, or study it. Originally, I think we naturally are inclined to think, hey, look, if we print money, prices have to go up. It's basic is the assumption, but it's obviously a lot more complicated than that. But
yes,
what you're suggesting is that perception, whether it's right or wrong, could actually end up becoming true, because the more printing we see, the more disillusioned we get.
Well, it's kind of, yes, it's that, because people inherently know there's something crazy that's going on. Something doesn't feel quite right. And, inflation, when they created this whole system back in 1913, if you read Keynesian economics, what they say, 1 man in a million does not understand inflation, and that inflation causes nominal confusion. So if I had a $20 bill 10 years ago and I have a $20 bill today, nominally they're identical. They're both $20 bills.
It's $20, yeah.
Right. But what that $20 bill would buy you 10 years ago, and what it would buy you a year ago, and what it buys you today, very different. Very different. And so, just think about this for a second, because this is, and I don't know why this always stuck in my mind, but my father was a developer and he used to work out of the house, and he built a very nice house, very high, high-end house. And there was this young couple, and I remember standing in the doorway and my mother going, he's a comer, he makes $12,000 a year. Now, he worked for IBM, he was an engineer, but the average income then was $9,500. So somebody making 12,000, that was substantially higher, right? And I used to babysit for them, 25 cents an hour, right. I mean, you have to put it into perspective. They would go on vacations. They went out all the time. Today, I think the average income is like 48,000. So most people would go, well, yeah, I want 48,000, not 9,500, except a family of 4 could live on that 9,500. I'm not saying they were super wealthy, but they only needed 1 income. Today, you've got to have 2 incomes and you're still paycheck to paycheck. And so when you see your debts climb and you see that your income cannot keep pace with the rising prices, then you start to get disillusioned. And you see, so it's not disillusioned in say the dollar, which is why the new Fed money, the Fed Now account, will hold digital dollars. And I can tell you, being there in 1971 in July with a $20 bill and in September with a $20 bill, I didn't know anything had changed. Even if I had a brand new $20 bill, when you do a study of bills during these currency transitions, they don't look a whole lot different than the previous bill.
Right.
Because then people would understand that something has changed. So they have to keep the name, and they have to keep the appearance of normalcy as much as possible. And they have to create distance. I mean, you read those IMF reports, and very often they'll say that they need distance between policy and policy implementation, right? So, I mean, we're seeing it. I'm seeing it through this whole piece right now with stores not accepting cash. Well, they wanted to get rid of the cash because they need us to go digital, so that there are no restrictions on how low they can push interest rates, and also on the level of control that they can have over your spending and the data.
Wow.
Right. They've even said in a recent CBDC report that I read, they're thinking about, well, how can we pay for the cost of the CBDC? Because they certainly don't want you or me to know that there's any cost involved. And they actually are discussing selling our data to third parties. This is the central bank.
Wow. Where did you read that?
100%. Yeah.
I mean, okay, so that's interesting. So to break that down, it is a good amount here. To break that down, you're saying, as the Fed, eventually it goes or transitions to a central bank digital currency,
Mhm.
there's going to be a cost involved in actually maintaining that currency. Now, I mean, there's a cost obviously involved in printing or minting coins and currency. So I imagine there's some kind of offset there or comparison there. But to help pay for that, hey, maybe here's just another revenue stream. Let's sell everyone's data. Because I mean, in theory, if the IRS asked me for my Bitcoin wallet address, they would know exactly where every dime of my money went because it's a permanent ledger. The same would be true in a, let's say, a digital dollar is what you're saying. So, hey, let's get people used to digitizing.
100%. And then they have absolute control to nudge. And by the way, let's talk about the printing of currency again, because it costs the same to print a dollar bill as it does to print $100 bill. But you
Right.
have to work a whole lot more for that $100 bill than you do for that dollar bill.
Right.
And by the way, there also used to be 500, 1,000, 5,000, 10,000, and even $100,000 bills.
Wow.
Yeah, but they
That's
got
fascinating.
they got rid of the ones over 500 or 500 and above as they made the transition from a gold-backed currency to a debt-backed currency. And they didn't demonetize it like they did in India and say, oh, this is no longer money. They
Yeah.
just very quietly withdrew it. So if you made a deposit, then those bills never came back out in circulation. And so hence today we don't realize. But that was a way to hold a lot of wealth in a very small package. And that's not what they want. And so they don't want you to have cash today because that eliminates cash is actually a debt instrument that holds zero coupon, right?
Right.
So it protects your principal, doesn't protect your purchasing power. It protects
Sure.
your principal, but it eliminates or creates challenges with them taking it as deeply negative as they need to get you to spend it. It's very interesting, really.
It is because I'm going to go back for a moment because it ties into this talk about people not realizing this change happening. I think there's I'm sure this is a study of some sort, but basically the bottom line was people were surveyed. Hey, would you essentially rather have, like, what would you rather? A 1% pay increase, but 2% inflation. So your purchasing power just went down net 1%. Or there's 2% deflation in the market, but you're taking a 1% pay cut. So your purchasing power actually went up a 1% in the deflationary environment. As soon as people heard pay cut, nope. Nobody wants a pay cut. They all want the pay, right?
I love that you said that because
Yeah.
when they were creating this whole system, this was actually the debate. Corporations wanted to be able to pay you less, but they knew if you were used to getting $10, you weren't going to accept $5. However, if they created the inflation so that they paid you $10 or they paid you $15, but it actually spent like $5, then they could get away with it. So this was part of the plan. What you just said, absolutely part of the whole plan. Because if, on the other hand, you got paid in gold, which has the most functionality of anything and the broadest base of buyer of any asset as well, if you had gotten paid in ounces of gold back in 1971, don't hold me to this, but I have the data, it would have been something like 235 ounces. If you did not get a raise, but you were paid in the same amount of gold, I think that worked out when I did the calculation the last time to like $341,000.
Oh my gosh. Jeez.
But
just to
because
keep pace.
people don't people just don't understand it.
Yeah.
So that's how they get away with it.
So really, I mean, the more inflation we have, the easier it is to pay off the debt. So in some sense, the reason, or one of the reasons, the Fed is like, please, we want 2% inflation. Even just a couple weeks ago, people are freaking out like, oh, bond yields are rising, and everybody's looking at Jerome Powell like he's going to come save the day. Wait a minute. Jerome's bluntly saying we want inflation. So it's no surprise he didn't do anything. Do you think that they say they want to run hot. They want to run to 2.5%
Right.
inflation. Do you think they're going to go very hot?
I think that this is my opinion, but they haven't been able to hit on what they measure. Okay. We have to be specific, because if you and I are living in the real world, we know they more than hit their 2% target. They're closer in most cases to 10%. But in what they monitor, they have not been able to hit that 2% target since 2008, right?
Right.
And so when they couldn't hit that, then they came out and said, well, we're going to go for an average. And at that time, I said, that's because they're starting to lose control of interest rates, and they know it's going to run a whole lot hotter. And so they're getting us used to that, so they can come out and say, like they have, right? Well, we're going for an average here. We're not going to do anything. We want this inflation.
Well, what's even crazier is the acronym is pronounced FATE. Like, this is FATE, is flexible average inflation targeting.
This is FATE. This is
So,
FATE. I hate to say it. I agree. It's totally FATE.
So okay, this is interesting. So first of all, I agree with you. I mean, there are a lot of things that are not included in CPI, and I think the Fed uses PCE, but roughly the same thing. Real estate prices and the correct weights probably for food and things aren't there. So definitely some issues there. But we said after that was interesting about, you think they're trying to get us used to higher inflation. So the Fed, in other words, you're saying the Fed realizes they're running out of options here. The tool belt's getting a little light.
Well, I would say they have no more tool belt. Okay. They, it's just the same old stuff. And they're justifying losing control. That's 100% about what I would say is there's justification for them losing control. And going back to those 120 billion a month, and also when they went in for corporate debt, and we're going to buy corporate debt, and we're going to buy the stock. Look at Japan. We're going to buy all that debt. We're going to buy all the stock. We're going to be everything. We're going to keep everything up. All right.
It's the everything bailout.
Exactly.
Fortunately, I don't know. I don't think they ended up buying stocks yet here. I know they did in Japan. They did corporate ETFs, which was a big move. But you're right. I mean, the next step is they just come in and start bailing out the stock market directly.
Well, so directly, because they did bail out the stock market with their
indirectly they did
policies. They absolutely 100 gazillion %. Are you kidding me?
No, you're right. You're right. You could say it was indirect, but it was definitely, I mean, the stock market was the first thing that got bailed out. So I want to go back to something that you mentioned here about people's expectations and that disillusionment starting. You mentioned universal basic income. I don't think you support that, because I think what you're saying is that's going to happen as a way to calm people down while this inflation happens. But it's just going to keep getting worse, like the government's or the Fed's control of currency. And basically, UBI is just the next step on this path towards everything collapsing, essentially. Correct.
Or hyperinflation. Because a lot, we've seen this, and this happens through every crisis anyway. We see a spike in savings rates, right? Because if you are not comfortable with where your income's coming in, where your income is coming from, then you're not as likely to go out and spend, right? You're going to save because you are uncertain. But if you know you're going to get a $4,000 check every month, or $2,000, or whatever it is, then you say, well, okay, I'm going to get UBI every month. I can go out and I can spend. And that's much of what we've seen over this past year with all of the stimulus that they've given to the population. We have a high savings rate, we do, but we've also had a lot more spending, because either the money is going to, and I don't really want to say people that don't need it. I don't really want to say that, because it's gone to those that they deemed were too big to fail. And I guess maybe now the little guy is deemed too big to fail, because we're the economy. And There's no way. I said this as soon as it happened, no doubt at all. They could not have done what they did in 2008. They would have had revolution immediately. No
Wow.
flippin' way on God's green earth. 2008, it's not that long ago. People have
Why?
remembered. Why?
Yeah.
Because if they had just bailed out the banks and the corporations without giving some to the little guy, we already have. This whole system is designed to create that income and wealth inequality. This is not an accident. This is not oh my gosh, this is not capitalism. This isn't even crony capitalism. This is fascism. We live in a fascist economy. There's no doubt about it. So the reason why they had to is because they would have had a revolution faster than they're going to have a revolution.
Wow. So that's fascinating. So what you're saying is, in 2008, if they came in and did the bailouts we had today, then with Lehman Brothers or whatever, like if they didn't go BK and it's just like, let's just buy their stock, let's buy everything, there could have been a revolution from the people essentially against this regime.
Right.
Wow.
Absolutely. And it didn't really stop it. It only postponed it. And UBI isn't going to stop it. It's just going to postpone it because people still don't understand inflation. But every time they do that, even though we haven't seen the hyperinflation yet from all of this money printing, wait, let me rephrase that. Even though we haven't seen the hyperinflation in our day-to-day lives, it's being held inside of these propped up markets, stocks, bonds, real estate, and particularly derivatives, which are the bets that are created against these that are far larger. Last August, the nominal value of these derivatives, according to the ISDA, which is, the self-proclaimed agency that oversees and creates all these derivatives, was 640 trillion.
Oh
640 trillion. And whenever you hear the word nominal or notional, or relatively speaking, frankly, then you're not really seeing what's real and true. You don't know, and everybody admits they have no idea of the value, the true value at risk in all of these bets. But that's going to blow the system. There's no doubt. I mean, they just had to postpone. I mean, there's so much about Libor, right? We're talking about interest rates, the Libor interest rate benchmark that they discovered in 2000, or it was spread out in 2012. They knew this. It's a stated rate. So it's pretty easy to go, yeah, I think the interest rate should be 2% or 1.5%. Okay, that's just my opinion. So it's a stated rate, right?
Sure.
But when the public found out that it was a stated rate, well, then they had to change it, right? And they just postponed it. They ran a test on 80 trillion in October. And shortly after that test, which basically went dark, I mean, the results of the test, quiet, not a word. And then a couple weeks, 3 weeks afterwards, they said, yeah, well, we're going to postpone this for a couple more years. Why? Because they can't change it. Because they would have to restructure 640 trillion or something like that. Any contracts that matured after December 2021 had to be restructured or reset. And that's never been done before. Everybody's got to agree. So they postponed it. Does that mean it went away?
Yeah. I mean, and derivatives they were really what led to obviously the disaster in 2008 with the real estate crisis as well, all the CDOs, collateralized debt obligations and such. So I want to ask you though, I mean, obviously now we're in this K-shaped recovery, right? Where the rich get richer, the poor stay broke. I think people or society says, well, that's because the way things work in America is you have to own assets. You have to own businesses, stocks, and real estate to get ahead. And if things go bad, don't worry. the government will always bail out stocks, businesses, and real estate first, which they did. Tenants get what you don't get evicted, but homeowners don't pay your bills for 12 months, right? So the stock market, obviously, we know what happened there. So stocks, businesses, real estate, they get bailed out first.
Anyway.
At least big businesses, sure. Yeah. And the PPP, for whoever was able to get it, great tool. But you're right. Yeah, absolutely. Big businesses got the disproportionate lion's share there. So common wisdom today is, well, in that case, if you want to join the upper part of the K-shaped recovery, get into stocks, real estate, and business. But it sounds to me like you're saying this is way bigger than just transitioning into getting people educated on wealth and investing. This is actually like the whole system's so rigged, and it's just a matter of time before people actually realize it. And then there's gonna be a problem, which I want to hear what that is. But yeah.
Yes, that is a really good summary of what I'm saying, because you have to get rid of the old system before you can really fully go into the new system. And, one of the things that tells me how close we are to it, frankly, is the average person getting into the stocks and the bond market and the real estate market as an investment, because we saw the same pattern. In 1928, that's when the general public, who got credit for the first time, go on margin for the first time. But that was right at the point where the industrialists and the people that understood that it was just a paper market and how fragile and vulnerable it was,
they
were selling out to the general population. And then the credit was pulled out from the public because we were not, again, too big to fail in 1929, and we had that crash. And if you look at every major crash, like I was there on Black Monday in 1987. I was a new stockbroker. I was about a year into it. And because I was not the best day I could have ever been a stockbroker, I'm telling you, what I learned that day and then after that was just amazing. But I have to tell you, that was the start of globalization. That was really the start of the system. And so everything looks hunky-dory for a while, and lots of people are doing really well. And then all of a sudden, the rug gets pulled out from under you. And the other thing I'd like to kind of point out here, Kevin, if you look at the World Economic Forum symposium that's coming up, well, you own nothing and you're happy. Well, if you don't own it, somebody else does, because wealth never disappears. It merely shifts location. So if you hold all of your wealth in intangibles, and and all you can convert it into is the dollar that has zero value, what do you have? That's why, I just have my little silver things here and gold things, but that's why you've got to have intangibles outside of the system in order to, and real money, so that you're in a position to take advantage of those opportunities when they present, because nobody's going to know when this whole thing is just going to come crashing down.
I love the sound effect. That's perfect. So, okay, I mean, if there's going to be, when and if this comes, how does real estate fare? I mean, it's interesting that what you're saying, if like, hey, if you've got intangibles, which really, I mean, we don't even hold our own stock certificates anymore.
Well, I was part of that. I remember that. Get them to hold it in-house. They're going to immobilize these, because then they can use your collateral for their benefit and go out and borrow and do whatever they want. So yeah, sorry, go ahead.
Yeah. No, that's a good point. But so, I mean, really, your take is that as the Fed loses control, we will continue to see these forms of universal basic income, like we already seeing with the child tax credit is a form of that, which they've only got that in for a year. But, when that comes up for expiration next year and Dems are still going to be in control, and this is not to get political at all, but we expect, obviously, that could get extended. So then maybe that gets increased. Then we kind of start inching towards like, hey, look how good this has been. Let's do some more. And so that kind of is part of your transition argument here. And then also, normal everyday people getting invested in the market is part of, and going into margin maybe is also part of your transition. At what point, like what's the warning sign that says, okay, now we're going down this path? At what point do we start seeing that U-turn where it's like, oh, here comes that hyperinflation, or are we already seeing that?
Well, I'm not willing to put my technical neck on the line yet, but I think a great place to watch it is the monetary velocity at the Federal Reserve's website, the Fed, because when that starts going up in a pervasive way, what that monitors is the speed at which money changes hands. And what will create the hyperinflation is a lot of those dollars chasing a finite amount of goods, right?
Yeah. Yeah,
So,
I did that. On that note, I was playing with a spreadsheet just a couple weeks ago. I was looking at the velocity of money. I think I was using M2, which is not too far off. I was using
doesn't
M2.
matter. You can use that.
Yeah, and right now, before the pandemic, we were at maybe a velocity of money of like 1.4 or something like that. It was it's been declining, and now when we start looking at the amount of printing that we've done, when we run the math, we're at like 0.95 or something like that with all this money that's been printed. And the bottom line that I saw in the spreadsheet, which kind of made me like sit back and I'm like, no, this can't be right. But then maybe it can be, is I took all the money that has been printed and the total money supply now, and multiplied that by the old rate of before the pandemic, the 1.4. So going back to the old velocity of money we had, not this low velocity where everybody's stuck at home, not spending. And if we went back with all this new money that's printed, if we went back to the old velocity of money, we would have a GDP somewhere around 50% larger than what we have right now. And there's no freaking way we could have GDP growth of 50% in even 3 or 4 years without seeing mega inflation. I mean, that'd be like 10% compounded annually, So now I think the Fed makes the argument, oh, don't worry, we're not going to go back to that velocity. We're not going to go back to 1.4. And in some case, I mean, they're right. I mean, if we stay under 1, fine, then we won't see it. But it proves your point here.
Here's the thing.
Yeah.
If you go and you look at that, whether it's the M1 or the M2, they took the M3 away from us in 2006. Because what do we really need to know how much money they're creating? Right? But what that also really indicates is whether or not taking on debt is actually stimulative, or at what point it starts to shrink your economy. So the peak of that was 1997. And after that, the velocity of money, I mean, there have been times when it's had a little bit of a rise, but it has been declining massively. And in fact, back in 2013, according to a report by the Federal Reserve, the velocity of money was lower than it was during the Great Depression. So it is,
wow.
Yeah. And it's gotten a whole lot worse since then. So this is not a good thing. And they're creating the money, people going out and spending the massive amounts of money that has been put into the system. I mean, why isn't the monetary velocity increasing? Why isn't all this new debt stimulating anymore? It's because you have to service the debt. So if you have to service the debt that you've already taken on, it's kind of hard to go out and take on even new debt, which is why it's so important for interest rates to be low, because then it's easier to take on more debt and service more debt.
Yeah.
But as the interest rates go up now, and all of this debt or a ton of this debt has to be rolled over, then that eats up more and more of your income. And if you look at the government income over time, it has not kept pace with the level of debt. Look at the deficits. But don't worry about the deficit. What do we care?
Well, now they're redefining how we should contextualize the deficit. It used to be, oh, the debt went up this. Now they're saying, yeah, the debt's up, but now we want to look at it based on how much our interest payments are, and those are lower, so let's borrow more.
Exactly. And the whole point of lowering the interest rates, or presumably, was so that these corporations that had taken on too much debt could go in and reset that debt at a lower rate, pay it off, etc. But did they do that? No. Now we have massive zombie companies, which were only really prevalent in Japan, and now they're globally prevalent. And that means that they have not earned enough over a 3-year period to cover their interest payments, let alone any of the principal payments. Right. But because the banks do not want to show these bad loans on the debt, you recently did a great piece on the reserves, right? But because they don't want to show these bad loans on the book, they just keep loaning them more money. Now, I got to tell you, the only people that I'm going to loan money to when I absolutely know I'm not getting it back are my children.
Yeah, everybody else want their principal back. Very fair. Is it possible that the velocity of money could stay low though as well? Like, okay, so we know we've got this K-shaped problem where the rich are getting richer. What if they just spend less, but they're just like, yay, I'm richer today. Isn't it that a possibility?
How many airplanes do you need?
Yeah, exactly. Yeah.
Right? I mean, how many do you really need? So right. I'm not so worried about the rich spending money. The rich invest, right? Yeah. They'll buy assets. They'll buy gold. They'll buy silver. They'll buy real estate. A lot of them are selling into this rally, but it's the little guy. So isn't it possible? Well, if you're hungry and you get money in your pocket, are you going to go, oh, I'm not going to spend that. I'm not going to go out and buy my children food, or I'm not going to go out and buy my children shoes or something like that. So giving it to people that are likely to spend it is also, we're going to see this inflation.
Okay. And that is actually consistent with your argument that the more UBI, the more spending, that's when that velocity of money is going to go up. It's not, the velocity might not come from the wealthier folks. Gotcha. Okay. So what do you advise then? Like what do people do? I mean, is real estate okay? Is it metals? Is it crypto? Is it Tesla stock, or is it Tesla cars? What is it? What do I buy?
Well, look, first I'm going to say everybody's got to do what they're comfortable doing, but since I've studied currencies since 1987, and I've been in the gold market thanks to my uncle since 1964, then, for me, this is what I think everybody needs to be comfortable. Food, water, energy security, barterability, which is, for me, it's silver, wealth preservation, community, and shelter. Because that's what we need no matter what's going on to have a reasonable standard of living. If you want to speculate into cryptocurrencies, I don't know which ones are going to survive. Now, it certainly does look like Bitcoin is going to survive this. But at the end of the day, when we get that inflation and they reset the current currency into the new currency, do you think they're going to reset it against Bitcoin or Tesla stock or even real estate? No. They reset it against gold money because it has the greatest functionality of any asset. It is used globally in every single area of the economy. And it's finite and it's indestructible. So we can account for pretty much all of the gold that has ever been mined. And there's more than 4,800 cases of currency resets, and 100% of the time they do it against gold.
Wow. So in any currency collapse is kind of what a reset is.
Yes.
I would argue that. Okay. So we agree with it. Okay. 100% of the time, back to gold.
Against gold.
Right. The backing it. So, right. Not exchanging gold, but currency backed by gold. Now, I believe, it was a little hard for me to see, but I think you held up gold for wealth and silver for transaction.
Correct.
Okay, why?
Well, okay, number one, silver is a secondary currency metal, and it does get used up in industry. So this gold is the money that has all of the qualities to be a good money. And the reason why is because, like, I mean, I don't have any problem cutting this chopstick if I need a little piece of it, but this is a better way, or this has evolved as a better way to hold a lot more wealth in a teeny little place. So primary currency metal, secondary currency metal. If I were going to buy a building with silver, I'd need a lot of silver to buy that building, but I'd need a lot less silver with my gold.
Right. Okay, I get it. So it's maybe more, it's easier to divide up, essentially. That makes sense. So what about the argument that all this money printing is just fighting deflation? And even though there are temporary concerns of inflation because of the money printing, because we're fighting inflation, or deflation rather, the Fed's going to end up being right, and we might not even get to 2%. And we go, wait a minute. Now we've invested in all these inflation hedges, like Bitcoin, for example, and inflation doesn't happen, which I don't even know that you probably, I don't know, I want to hear your comment. I don't think we've found that Bitcoin is for sure an inflation hedge. Maybe gold would be, I think, better than that. But anyway, what if that doesn't happen, though? That inflation doesn't come.
Have you looked at the purchasing power chart from the Federal Reserve? I mean, here's the thing. We're always fighting deflation, because that's the way the fiat money system is set up. You weren't doing it when we were on a gold standard. You didn't have to do that. The economy would ebb and flow as a normal course of action. But because this money is by design supposed to lose value, right? We are always fighting deflation. A stock market going down, that's deflation. The real estate market going down, that's deflation. The bond market going down, that's deflation. So, and there's only one way to fight deflation, and that's with inflation. So they're just the flip side of the same coin, and it doesn't really matter whether we end up with massive deflation or massive inflation, or you could even say hyperdeflation or hyperinflation. It really amounts to the same thing. And so if we're completely digital, right, and they start to lower the rates low enough for you to notice, open your bank statement, you haven't spent any money, but you watch your balance go down, and it's just because of those negative rates, right? Then what are you most likely to do? Go out and spend that on anything that you think is going to hold its toilet paper, for God's sakes. I mean, I know you're laughing about that, and I know
it happened. Look, in March, it was nuts.
Exactly. And if you've been listening to my videos for years and years, you would have heard me say toilet paper, because for some weird reason, don't ask me why, I have no idea why, but for some weird reason, that is always the thing that flies off the shelf. And that people hoard. I have grapes. So, grape leaves are pretty big too. But, right?
But toilet paper takes up so much space too.
It does. It's inconvenient. It can be inconvenient unless you have like a big toilet paper closet. But I mean, it's highly barterable. And I'm glad you brought up March, because that was just a teeny weeny sip of what we have lying ahead of us.
Okay, well, I want to hear that. So what's lying ahead? Maybe not necessarily when, but how does this unfold? Because I think what you're saying is the Fed's walking this really thin tightrope of, we're just going to play over here between 1% to 2% rates and inflation, whatever. But your argument is, it doesn't matter which way they go. They're going to lose it one way or the other. We're either going to go to negative rates, or we're going to go to hyperinflation, whatever. One of these things is going to happen, and it's going to be a disaster. What happens then?
Well, actually, I'd say both of those things happen. Okay.
Negative rates and hyperinflation. Yes. Okay. Fair.
Right. And I do. What happened in March? You saw the grocery store that you saw that the supply chain is broken. Did it get fixed over this last year? No, it did not get fixed over this last year, right? So, and you saw, yeah, they had the PPP loans, but look at how many mom and pop businesses are gone, and they're not going to open again.
Right.
So those that had access to Wall Street, it wasn't so much that I felt like they got bailed out, but I think that there's going to be a lot more consolidation, because that's something else that happens during every crisis. I mean, there used to be, don't hold me to these numbers, but something like 535 banks. And in 2000, that's when they started consolidating. And now you've just got like 6 of the big ones or 8 of the big ones, something like that. So you're going to see a lot more consolidation like we have seen over this past year. You know, we have a tendency not to think about it because, that store is vacant now. Oh, that store is vacant now. Those are not coming back. And mom and pops generate about half of the jobs. So now you're going to have people that are chronically unemployed. We're seeing that. They may say the unemployment numbers are coming down, but they also say that we've got, about 10 million people that are still unemployed?
Yeah.
Right? So UBI, they're going to have to give them income one way or the other. But that's what we see. I mean, look at Venezuela. That's what we're going to see. So it's critically important that you be as independent and self-sufficient as possible. You know, have that toilet paper, but they'll say, "Oh, you're a hoarder. How awful is that?" I mean, don't hoard gold. Don't do that. That's awful. But central banks are hoarding gold, aren't they?
So you think we could get this a Venezuela type situation? I mean, that was it was a complete loss of control there. You think that could happen in the United States? I mean, look at the United States. It's like, oh man. I mean, that's if the United States collapses or their currency collapses, what's
happened here? Except it's happened here 3 other times. Civil War, War of 1812, and oh my God, let's see. There's one other time.
Maybe just back to the revolution. I guess that's from where.
Yeah. So I mean, we've got history as a guide. But the difference between then and now is that central banks used to have a charter for 15 to 20 years because governments knew they would abuse their power. And also the governments abused them when we went into war and hyperinflated away the value of the currency to pay the war, which is really what happened to transition us into this new one with the Vietnam War. And there was a run on the US dollar by foreign governments because we were the world reserve currency and we were abusing our power. And that's why Nixon had to take us off the gold standard, because we had less gold in our coffers than we did after the confiscation back in 33. So there isn't one doubt in my, there isn't even a teeny weeny possibility that, okay, I should probably say that. But if something happens 100% of the time, and it's happened over 4,800 times, and we're doing the same thing, oh, okay, maybe this time's different. But I don't think so.
Wow. That's like what is it, definition of insanity, doing the same thing but expecting different results?
Voila, you got it.
Okay, does the U.S. even have enough gold? I mean, I heard that maybe the gold reserve we have is, less than 10% of what the world actually has. I mean, could that lead to should we buy guns?
Fiscally in charge? Yeah, that could. And we've been watching that whole transition of power, right? From the U.S. to China, which is really scary. Because China's really showing us the whole world, how to do a full surveillance economy and how really to control your people.
Yeah, that's a good point. Jeez, wow.
That's why I like this so much. I'm telling you.
Well, yeah, it makes sense. I mean, do we think it's gonna would it go to gold or Bitcoin? Yeah, I mean that's a good argument.
But if you look at Bitcoin in China, were they not
Mhm.
able to control Bitcoin? Yeah. Yeah. The answer is yes. Actually, right now, and with the rise of ESG and the green economy and these kinds of technologies use an awful lot of energy. They're not particularly green. So, I'm not saying that the cryptocurrencies are going away, but if
Right.
you look at the Bank for International Settlements Money Flower, which they publish regularly, the private cryptocurrencies have a teeny weeny space, so they'll allow it.
Sure.
But their CBDCs have a much larger space, and then physical gold and silver, so commodity money, has the biggest space that is universally accepted and peer to peer,
Ah,
right?
interesting. Yeah, yeah. Because I mean, you look at India. You think India is going to go to Bitcoin or gold?
I mean, I really find it hard to believe that central banks that have been in control for over 100 years is going to go, yeah, we've had a good run. It's your turn now. Now, can it
No,
be
they're
a
not
Wall
going.
Street?
Jerome wants his job.
I'm thinking so. And whoever comes, I don't know why, because I would never want that job. But
He said he enjoys it. He says he thinks it's fun. I'm like, dude, you get grilled every day. How's that fun?
I don't know. I mean,
He likes
I
printing
have
money.
read papers that talk about the kind of people that are that hold those positions, and I don't want to say sociopaths,
Oh,
but
I gotcha. Wow. Wow.
well,
Okay.
because can you care if you're in a position like he's in? Can you care that your choices have such an awful impact on most people? You can't care about that, or you can't make those choices. Could you make
Whew.
those choices? I couldn't.
That's a good point. It's been mostly from the Fed. It's trickled down, right? It's bailout stocks, and then eventually maybe $1 of that $100 goes down to that person trying to get ahead making $20,000 a year.
Right. And by that point, that dollar's only worth 3 cents.
Oh goodness. Wow, a lot to digest there. Any final thoughts that you have? Where we hit an hour here, so I want to respect our time frames here. And any final thoughts you want to leave us off with? How to get in touch with you?
Well, I would like to say that I think everybody needs to, how do you eat an elephant one bite at a time? And whatever you're going to do over here with stocks or real estate or Bitcoin or any other cryptocurrencies, just make sure that you have a properly diversified portfolio in tangible wealth that is outside of the system, because they can control anything that goes on, through computers, etc. They can. Let us face it. They can. So don't be that naive that this is proven. And itmtrading.com is how you can find us. And we have a YouTube channel. So if you do a search on my name, Lynette Zang, or ITM Trading, that'll come up. And, I like graphs. I like my graphs and my pictures. So, and we like human contact too. 888-696-4653. So I've been at ITM since 2002, and we like human contact. So we like conversations. We want to know what you're about, what you have to work with, what are your goals, what are your concerns. And we actually have a very holistic approach, and we execute the strategy that originally I created for myself. Been studying currency since '87. And, but everybody there, we've been together for so long and they're so brilliant. We just consistently try and improve and make things better and better and better. We are here to be of service, and I'm definitely here to be of service.
Amazing. Thank you so very much. For everyone else, thank you. Lynette, stand by for one moment. For everyone else, thank you for watching. Consider subscribing, sharing, liking the video. Folks, thank you for being here, and we will see you in the next one.